All right. What's up, everybody? Hope you guys are all having an absolutely amazing day. Welcome to our live streaming session here on YouTube. It's our we're going to do a little bit of we'll call it a midday market commentary. So for those of you that are watching on YouTube that don't normally watch us in our live trade rooms. We do this a couple times a week inside of Traders Army's live trade rooms. I thought it'd be nice to kind of do one. Here live and for y'all to kind of get to see and to take part of. So we have a chat box up there. I think there's a little bit of a delay on the chat box. So if there's a little bit of a delay on the chat box and I don't get to your comment right away, then I apologize. But do me a favor, go ahead and feel free to use the chat box. I can't exactly see who all's in the room, so do me a favor, type in the chat box, say hello, let me know your name, let me know where you're watching from. Always great to know where you're watching from. And if you guys are new to the channel, do me a favor, give me a like, give me a thumbs up, whatever in the world it is. And I know a lot of you are going to watch this on recording, so as we watch the archive, then hopefully we'll see what happens. So today what I want to do is I always go through the futures markets, but I thought today would be a good idea to talk in terms of not just the futures markets, but also take a look at maybe some options positions and kind of what it is that we look at in our live trade rooms on a pretty regular basis. So charts are a bit blurry. Yeah, unfortunately, John, I can't control how well it comes across through YouTube. It says that my stream is healthy, as they say, but I'm not sure how it comes across. But I'm gonna expand them and make them a bit bigger. So hopefully that'll be a little bit easier, John. So thanks for the heads up on that. So what's up, Mr. Doug? And Olsey, good to have you all. All right, so today in the S&P this morning we had a level that we were doing the live trade room this morning, and I just didn't feel like there was any reason to force a trade, and there was lots and lots of reasons to not force a trade because you had so many different areas where the market could just go against you. Meaning, if you tried to take this breakout to the downside, you had this area of demand here that could stop it. So if you tried to take a breakout here, then you certainly had this supply up here that could have slowed it down. Now, hindsight being 2020, the breakout to the upside worked out just great. And so, the upside breakout was great, but I'm not willing to take that because that's a lower probability opportunity. Now, since then, that has driven us up into our supply level. Our supply level that we set is a zone that was an origin of a very strong move. Now, for those of you that are familiar with what I look at, what is important about this strong move? Yes, it's a strong move down. It's the origin of a drop in price. But there's also something very significant about this origin, why it looked like it might make a decent little turning point. What do you think that was? What do you think was the origin? What do you think was the thing in here, for those of you that are familiar, that I looked at? So, because if you know that, then you understand, one of the key things that not everybody's paying attention to. Now, at this point, if you did take that short, I am not a huge fan of this and this. These lower wicks here, to me, those wicks indicate that there's buying pressure coming into the market. And so if you took the short, you've gotten, probably a good 10-point move out of that level. You could have gotten as much as 14 at one point. So the thing to do on this point, I think, is to take your stop and at least, if you've got some money, take it off the table or move your stop to break even. I'm not willing to mess with wicks on hourly charts, especially, going into the afternoon session. So very good, by the way, for those of you that looked at this area and knew what we were looking for. It was the time of day was super important. Something that's created around the European market open. I think the European market open is one of the most underutilized, high-quality times a day for traders to be able to find good turning point opportunities. I love to look for trades that are created around the European market open. Now, it's not just that. It's also the fact that in the past, that was an area which was the origin of a little bit of a gap down. And so the question is, are there a bunch of algos and trading computers that have already got this area programmed in? So I think the area was a pretty good level, but the buying power coming up into it is a little bit scary. So definitely one of those things that is a good idea to be safe rather than sorry. If you did multiple contracts, it's not a bad idea to maybe take some off the table with all that buying pressure and then move your stop down to a break-even area. So that's one of the things I'm looking at in the S&P. Now, I want to take a few minutes and look at it a different market. And the different market, also, by the way, it wasn't just the S&P level. It was also the Nasdaq level. The Nasdaq level that we drew this morning is also working extremely well, moving off of that zone, giving you an opportunity to take a little money off the table. So both the S&P and the Nasdaq level. But one I want to talk about today is the Russell, and we covered this trade a little bit earlier today in the live trade room. But I want to bring up this Russell trade. So when I look at the RUT overall, the RUT is our small cap index. Now, looking at these four markets together, I tend to do a view of the major market comparisons. And when I'm looking at this, this is the daily chart of the major market comparisons. Let me just put the last 1 year. So this is the last 1 year. So over the last 1 year, the S&P is up 5.51%. The Nasdaq is up 9.83%. The Dow is up 3.53%. But look at the Russell. The Russell is down 5.69%. So the Russell is actually negative, where every other market is positive. Now, that's one indication. The other thing to look at is, let's look over the last 90 days. So if I look over the last 90 days at their percentage, and I tend to do this, is I want to oftentimes look at how these markets compare really with one another. And over the last 90 days, we can see very much the same picture, right? So the picture that we're looking at here is that the Nasdaq's up 9%, S&P's up 5%, Dow's up 5%, Russell is negative 0.2%. So what we can see here is that, now let's really trim it down. Let's go to the last 20 days, so essentially the last month. Now, over the last 20 days, all of the markets are down, but the Russell's down twice as much as everybody else. So what does this tell us overall about the Russell? What this tells me is that if I want to go short, if I'm looking and I think, you know what, because there's a lot of news out there, there's a lot of people out there that are saying, hey, we think the markets are looking weak. And I would agree with that. When I look at a weekly chart of the SPX, the actual index itself, I think that there's no question we are seeing a slowing of momentum in this region, right? If I throw our momentum indicator up there, it's very easy to see that I have, if we look at this swing high in price and the next swing high in price, higher highs. Well, this swing high in price corresponds to this swing high in the MACD, and then this swing high corresponds to this one. This is very strong negative divergence, right? This is negative divergence away from one another. Now, if I take these two swing highs, they're about the same, and there continued to be divergence in the S&P. So we're getting more and more negative divergence inside of these markets. And so with those negative divergence markets occurring, that's a big momentum weakness. Now, does that mean that I want to short the S&P? Not necessarily. If I look at the RUT is actually already significantly lower than the S&P. If you look at the SPX, we are very near an all-time high. The RUT is obviously significantly lower. So we're going to take a look at what does a speculative play look like to short the Russell and take it. I don't think it's unrealistic for the RUT to be able to have a pretty good drop off of one of these levels, okay? So I think it's okay for the rut to look like a short off of one of these levels and for price to come down from here. And so I think it's a good idea to look at a trade perspective. If I'm going to look for a trade idea that's a little bit more speculative and I'm looking to be bearish and I want to take advantage of the market maybe in a negative, in a downward move, the Russell's going to be the market that I want to do that with. And I'm going to do that using options. Why am I doing it using options? Well, I mean, I could certainly do it using futures markets, but the downside of using futures markets is that sometimes the margin can get a little bit difficult in an overnight market. Over the weekends, I take a lot more gap risk. The great thing about using futures is that when I use the futures, I can still, the great thing about using options is I can use the options, still get a lot of leverage, but lower my overall exposure. So what I'm going to do is take a look at the IWM. And this was a trade we actually looked at this morning. We looked at the 150 by 140 bear put this morning, which was a 352 debit. So it's a $10 spread at a 352 debit. Now, I will say this morning we looked at it, the delta was at 26. So it's a bit lower on the delta. We want our deltas to be a little bit closer to 25. So we'd want our goal of our deltas to be a little closer to 25. So in that case, I might have to do the 150 by 138 in order to get it to a 25 delta. So it winds up being about a $12 spread. Now, when I look at this, interestingly enough on this trade, what's great about it is if you really want to be speculative on this position and you're looking at the IWM, I'm looking at it now as to say, well, I think that it's very realistic that the Russell can make it to 135. Obviously not today and not probably for the next few weeks, but I don't believe that it's unrealistic for the Russell to make it to 135. So if you think about the Russell making it down to 135, where am I proven wrong? Well, I'm going to be proven wrong if it comes up above this pivot, right? So if we come up, if we come up above this pivot, then I'm going to be proven wrong, and the market's going to maybe continue to march higher. But I think that there's a good chance that we'll make it through this little bit of demand. And the reason I feel like there's a chance that we'll make it through this demand is primarily because this demand has, there's been basing in front of it. It's been touched once, so it got touched right here. And since it got touched right here, we've got another little area of basing just above it. I think that this area of demand is fairly weak. Tell me what you guys think in the comments below. I'd love to hear your thoughts on that area of demand. But that's my outlook, is that this is not a very strong demand zone. Now, as we head into October, I believe there's a chance that we're going to see a fair amount of weakness from a fundamental perspective. And from a fundamental perspective, if we're heading into some weakness, now that fundamental perspective is really because of the strength of the dollar, right? My belief from a fundamental standpoint is that the strength of the dollar is going to have a negative impact on the overall earnings of a lot of companies that have that. Okay, so the thing that I look for is, the economic impact of those pieces are going to be a big move if the market can absorb some of the negative earnings. Then maybe we'll stay afloat. But if not, the options positions give me a good shot at it. So this would be the one that I would look for price to come down. Yeah, and that's a great point. October is somewhat seasonally bearish, and so this one that is typically seasonably bearish, I would look at this as an opportunity to say, okay, how can I trade this? So let's look at the IWM and look at the best way to build it. So a vertical spread, I think, is the way to go, knowing that where our exposure would be. Now, I think that above 150 would be my stop loss point. So when I look at the risk graph, for those of you that are not familiar with risk graphs, a risk graph shows me the value of my position over here on the left, and it shows me the price of the stock down here below. So the price of the stock down here below, if the stock price goes up to 150, I can look and see how much will I anticipate losing. Now, I anticipate that if it goes against me, your losses are sitting around $66 for one contract. That's not a very much exposure, even if you got into the position right now. Now, this is we're looking at November the 15th. For those of you that are not familiar with the risk graph of this platform, this is ThinkorSwim by TD Ameritrade. Look in the bottom left-hand corner of the risk graph where it says the dates, 10/6/19 in red and 11/15/19 in blue. The 10/6/19 represents the value of the position today. The 11/15/19 represents the value of the position on November the 15th. Now, why did I pick November 15th? Primarily because I'm using a December option. So my loss will be around $67 a share. If it goes my way and it goes down to 135, my profit on that date looks to be around 475. Now, what's great about this is that I've got a really nice reward to risk scenario on here. If it makes it down to 135, I've got a really good return. Now, where would I adjust the stop? If the market gets down below here, somewhere down below here, I'm going to quickly move my stop to the next pivot because I want to minimize and frankly eliminate that risk if I can. And so if I do that, as price continues to drop, whenever I get a pivot, I'll continue to move that stop down. Leave me a comment down in the comment section. Does that make sense to everybody as to why we would move that stop? I think it's an important thing to move stops, but not too early. When I do move stops, I only want to move stops in the position where I'm going to still be able for price to continue to run, and so adjusting the stops to above that pivot. All right. So that's my thought on the IWM. I think this is a very and Mike, I'd love to hear your comments in there, what you think about that. I think that's a very good way to do it. I think it sets it up pretty nicely, and I think it's very low risk when you get into a position like this. All right. So there's my thoughts on the equities markets in general when I look at this, and I really like looking at it from an options perspective. Now, speaking of options perspective, one of the options that I want to take a look at is on crude oil. So let's talk about crude oil for a few minutes because I know a lot of people out there trade crude, look at crude, use crude as a way to do it. So, great question from VCast. Makes sense, but is the stop a conditional order, or do you check on it and close it manually? So I'm going to call it a little bit of both. And when I say a little bit of both, what I mean is I want to make use of alerts. So I am not a huge fan of just set it and forget it style trading. So I have, for example, this order in here, okay? And with that order in there, what I would do is just right-click and go to create an alert. And when I create an alert, I'm going to create an alert for when price comes back to this area, right? Now, the reason I do that is because what if it comes back up into this level in a way that I think there's some supply here on a smaller time zone that I may not get stopped out, okay? Also, if I just do a conditional market order, then I may miss out on splitting the spread. So I like to do an alert up here to tell me to get out. I'm totally okay, though, if you use a conditional order. What I wouldn't do is just use a limit order. I think it's still important to use the conditional orders, at the very least. So that's the key that I would look for in there. All right. Great question. I appreciate that. Let's move over to crude oil. So when I look at crude, I want to start crude on a weekly chart. Why in the world would I start crude out on a weekly chart? Well, because we've got to look at, we don't want to miss the forest through the trees. And when I start at the weekly time period, it allows me to see the forest kind of through the trees. And we saw oil drop as low as $26 a share earlier in 2015? We got that low? Rallied all the way up, got as high as 75, and now we're kind of in between. Well, if you looked at just this as a trend, you'd immediately be caught by the fact. What I look at is what I call price shock, and I say I don't say I call it price shock. It's just called price shock, and it's not the first time that I've that I've heard or seen of it. But the idea of price shock is look at the size of my red candles, right? Size of red candles versus the size of green candles. You notice the relative size of red candles to green candles? That tells me that when the markets go down, people are piling in. Now, the other thing I see, remember, this is a weekly chart, and I find weekly charts to be very, very, very telling. The other thing that I see here is the fact that we have a bunch of selling pressure on all of these weekly candles. Notice, all of these weekly candles had selling pressure, selling pressure, selling pressure, selling pressure. Even as they went up, they had selling pressure. So what this tells me, without going down and looking at the daily charts, what this tells me is that nobody wants to carry positions over the weekend. And that even when things were bullish heading into the weekend, people were getting out of the positions because they were too afraid to hold it over a weekend. That's very telling. Even this one, I mean, in this big gap that we have here, this gigantic gap. Now, this gap is bigger than it looks. Remember, this gap is from here to here. This is the size of the gap because it's a red candle to a red candle, which means we gapped from here all the way up to here. Now, that was on the Saudi oil drone thing, if you will. But the markets, nobody has been interested in holding oil positions on any of the weeks. So when I look at that, that tells me that even though we're in a sideways price action, I think there's a chance for oil to really get a fairly strong sell-off on a longer-term scale, okay? I think there's a chance for oil to have a sell-off on a longer-term scale that can be a bit more damaging than I think a lot of people are considering. When you look at quality areas of demand on the daily chart, we don't really have any quality demand until we step back here into the mid-40s. So how can I play that? Well, there's a couple of ways that can be played. So that can be played using USO, which is an ETF. And you could simply, you could simply short the ETF and just go short the market. I mean, there's nothing wrong with that. Now, by the way, if you do go short the market, where are you proven wrong? You're proven wrong above this pivot, right? So no matter what you do, you're proven wrong above this pivot. This is your stop loss point. So you minimize exposure overall by having a stop loss point. So one is that you could short it. Number two is that you could use options of the USO to short it. Now, if I look at my implied volatility range, so what you're looking at, for those of you that are not familiar with our implied volatility indicator, this is nothing special. This implied volatility indicator is nothing special aside from the fact that it takes the bottom 20% of the range and the top 20% of the range and just wraps boundaries around it so that we know where we are relative to its last 252 trading days. So when I look at this, we're in the middle range, which means I shouldn't just go out and buy a put, right? It means I'd be better off doing a bear put spread. Now, the problem with doing a bear put spread, when I have a stock that's this inexpensive, and I'm going to go out more in time, let's go out to December, is that I might have to do more contracts simply because it's a fairly inexpensive position, right? So if I do buy a vertical spread, I'll do the 12 by 10. 12 by 10 is a $2 spread with a 95-cent debit. So that's a little higher than what I would like. I could do the 12 by 10 50, and it's an 80-cent debit for a $1.50 spread. That's too high. So my rules when I do this, one of my rules is that the debit should be no more than 50% of the spread. And I want a delta of 0.25 or greater. So the 12 by 10 is a $2 spread, 95-cent debit. Delta's 41. So the risk graph on that, now the question is, where can price go? Well, I think that's realistic for price to make it to 10. I think that that's a very realistic price expectation with a stop at 11.30. So in this case, price can make it to 10 with a stop at $11.30. So looking at this on November the 15th, same dates, my risk on the position is about $12 a contract. My reward is about $58 a contract. So let's, instead of doing one here, let's do 10 contracts just to make the numbers at least worthwhile. My risk is, on 10 contracts, my risk is $120. My reward is $582 if it makes it down to $10 a share. So overall, I think this gives you a good opportunity to have exposure to the oil markets. Now, if you don't like USO and you want to find a different way to do it, what about doing the options on the futures themselves? So if I do the option on the future itself, I looked at this one a little bit earlier today, and when you do the option on the future itself, we would, in this case, be looking at, we're proven wrong if it gets above 54, and our target, I think realistically, is somewhere down here in the 47 range. So we were looking earlier at the 54 by 49 as a bear put spread. Now in this one, we're buying the 54, we're selling the 49. This one we did the January options. The January options have 67 days until expiration. Now the difference here is we're doing options on futures. So those of you in the comment section below, or in the comment section, let me know, have you ever done options on futures? If you've done options on futures, let me know what assets you've done options on futures on. But the difference between options on equities and options on futures, options on equities traditionally are going to control 100 shares of the equity. Options on futures are going to be based on the underlying futures contract. So in this case, our underlying futures contract controls 1,000 barrels. So when we look at this, the number that we get is going to be on the 1,000 barrel number. So I'm buying the 54 put for $3.71, selling the 49 put for $1.59. Okay, now that's how we build the vertical spread. If we just go and put it together. So right click, analyze buy. We're going to buy a vertical 54. Buy the 54, sell the 49. It does the math for me. $2.10 is the debit on here. Okay? So most of you guys have not. Take a look at using options on futures. There options on futures for those of you that haven't. It's a good way to get in. And crude oil is a good one because you've got look how tight the spreads are, right? 342 by 345, 292 by 295. I mean, these are very tight spreads. So if you're going to do one, this is a good one to do. So now, looking at this, here's my risk profile. If we think that our stop would be above 54 and a target down here around 48, my risk graph says that we're risking approximately $437. 437, 440, call it 440. And if it goes our way, we're looking at about 1565 if it goes down to 48. Now, the beautiful thing about this is, can it go lower than 48? I think it can. I think that if we break below here, I think it can go lower than that. Heck, I think it can go down to 45. And if it makes it all the way down to 45, that's when you really start looking at big returns. Okay, so it's a little bit more exposure than the USO position, but it also has a better delta than the USO position, where you're making or losing more on the dollar movement of the underlying. So those are two trades utilizing options. And remember, what we did here was we started on futures and then moved into options. Okay, so started on futures and then moved into options. So what I want to do next is let's take a look at bonds, currencies, and then some individual equities. We got a little bit of time left, but I want to do a real quick 30-second plug. Those of you guys that are interested at Traders Army, we are doing a free preview week, October 20th to the 25th. So if you are not a current subscriber, we're going to give you a week to peek behind the curtains. You're going to be able to join our live trade rooms, go to the open forum sessions. You're going to have access to our trade feed updates, the trade worksheets. We're going to have an actual a lesson night on what's called the options deconstructed sessions. So go to Traders Army, sign up for a free membership, and you'll get the information of how to join us for our free preview week. All right. Oops, wrong button. Okay, so let's go talk about our bonds and currency markets. So moving over to bonds and currencies. So here was our bond breakout trade for today. We talked about this one today. We talked about this as a breakout scenario, and the downside of this was that we didn't get quality basing in front of the level. We unfortunately did not get the quality basing in front of the level that would qualify this for a breakout short. The breakout worked exceptionally well, but I needed closer basing for me to really take this. So now what am I looking for? Well, now what I'm looking for is a retracement short opportunity. On a 4-hour chart, we have technically put in a lower low. I don't yet have a lower high, so it's a bit premature. But I think that we could get a decent return. Now, the level that I would probably lean on, we broke out right here, and I would probably lean on this wick over wick area right there, which is the area where two candlestick wicks came together, and we can wrap our lines around there for a potential reversal point. Okay. Now the level below there, this is the area of demand. This is kind of was our target point. We're getting a little bit of a rally off of this demand area. That's really where we're rallying off of at the moment. And so that demand area that we're getting a good little move off of right now, still valid. If we make it, if we make it back all the way up to here, this I'm going to still need to contend with if we get a reversal out of that level. So this to me would then become my first target on a short out of that zone. Okay, so for any of you that trade in the bond markets, I think that would be a decent little reversal play. All right. So And then currencies, we look at currencies. What's happening today in currencies? Our euro level that we found this morning in our daily market commentary, we got a little bit of a tick below and then popped up through it. So you may or may not have gotten a little stop out on this position if you went for it. I mean, it's literally just a few ticks below. May or may not have gotten a little stop out. We are getting a fair amount of selling pressure, though, coming into it. So if you miss it the first time, I don't know that I would go after it a second time, as I think there's a fair amount of weakness in that position. So I'm going to remove that one. Now, the reason I had that level in the first place was because it was the time of day that it was formed, right? The time of day that it was formed gave me a little bit more confidence to be able to look into it. The level down below, which is the origin of this speed candle, and for those of you that come into the room regularly, you hear me say this all the time, speed candles tend to get retraced. I might look at that as the next area for price to retrace back into here. It's not a great time of day. It's right around midnight, which is not a terrible time of day, but there are certainly better times of day to find opportunities. Okay? Canadian dollar is still nowhere worth trading. It's kind of still in no man's land. The Aussie, we had a little tiny 15-minute level here that price didn't make it down to where our stop would be, and we got a little rally out of it, so that one's okay. I'm going to remove it at this point, but remember the stop's going to go outside of the wick just before the zone. Oh, I'm sorry to hear that, Olsey. Yeah, that euro one was fairly tight, but the good news is that it was a small little level, so it's fairly small stop relative to risk. And then the last two I think that we looked at this morning were the pound and the yen. And I want to talk specifically about this one in the pound. So we had a really, really good short in the pound earlier with this move down. But once we hit it once, we then convert to a confirmation entry. Now, for those of you that are unfamiliar with how we do confirmation entries, I want to highlight that for you all so that you know kind of what I look for in a confirmation entry. So when I'm looking for a confirmation entry, let me put my drawing tool over here. When you see that we have a dashed line like this line right here, to me, that's a confirmation entry. A solid line like this area up here would be what we call a limit entry, okay? Now, a limit entry means that as soon as it touches the level, I'm in the trade, right? That's not the case with a confirmation entry. With a confirmation entry, we need to pierce halfway into the level. And then I only get in the trade as it comes back out of the level. So I would need a trade to look more like that before I would be able to get in. This is a good example of price did not make it halfway into the zone. We didn't make it halfway up. So there's no reason to have entered this trade. Now, why is it a confirmation entry? The reason that this confirmation entry is a confirmation entry is because of this. Because the first time we touched it, it was a limit entry. The second time we touch it is when it became a confirmation entry, okay? So with that limit entry and confirmation entry difference, that's only designed to keep me out of trades, okay? Now, the other thing that we had here was this potential breakout to the upside, okay? So this breakout to the upside is not a valid breakout. I can't take it. And the reason I can't take it is because I didn't get any basing before the level. It's really great to say, hey, look, I called this breakout way back here, and look at what it's done since then. Well, yeah, that's total crud because there's no reason to have taken the long. There's no reason for me to have jumped into the position. I need to only get in this thing if the market gives me the basing required before the breakout. Now, the reason that we're seeing it that we got these couple of wicks here was because we didn't get the basing as a stall point. Okay, so hopefully that makes sense on a little bit of a lesson on the pound and some of the things maybe that are worth looking for as you're identifying opportunities. Yes, Deepa asks a really great question. Do I look for basing the same time frame for a breakout? Yes, yes, yes. So if I'm on a 60-minute chart, 60, basing on the 15-minute level is not enough to get me in the trade. And that basing needs to occur somewhere close to the breakout point. So for example, let's use this ES level. So this ES level that I have in place here as a potential breakdown. Now, this actually worked for a nice little 2-to-1, but I left the line in place. Basing that occurs here will not be quality basing. That basing needs to occur somewhere in this region for me to be interested. I really want my basing to occur very close to the breakout. Now, it has to occur on the 60-minute chart because the line is drawn on the 60-minute chart. If I'm looking at a daily chart and I look at this daily chart for a potential breakout, well, in that case, I need basing above the daily or just below the daily level for a breakout to head to the upside. Okay? So that's an excellent question that I think a lot of people tend to, they go to smaller time frames and they say, well, it based on the 15 and I found the breakout on the 4-hour. That is too far away. I need it to base on the same basic time frame. Okay? Excellent question. So as far as the rest of the day goes and my thoughts on the rest of the day, my feeling is that we may continue a little bit of this sell-off. Remember what I said, take your stop, move it to break even, only because of all this buying pressure. This buying pressure always scares me. So take your stop, move it to break even, maybe take a little money off the table if you want to. But I'm a little bit more cautious about it. But we do also still have this big parabolic move, right? And parabolic moves tend to get retraced. So we will have to take a look at this as a potential. We'll see what the arrival looks like for price coming back into this area. Deepa says, any minimum candles for basing? I'd like to get 3 touches on the level. So 3 touches on the level is ideal, and basing is a little bit. Basing is, I'm okay if it's even 2 candles worth of basing before the level. I don't need a whole lot. What I really care about is that we have some basing, because what basing does is it allows the market time to aggregate more orders to go in the opposite direction. So, for example, if prices are going up and I've got some sell orders here and we base sideways, well, now we're aggregating buy orders. And if it's a supply zone, we're aggregating buy orders. The opposite of the supply zone would be price rallying higher. I think one of the things people make the mistake of in the world of trading is that they think breakouts and reversals are different. Breakouts and reversals are exactly the same trade. A breakout and a reversal are both the exhaustion of orders, and understanding that is the key to getting good at trading breakouts. Ingrid, good to see you this morning, afternoon, evening, whatever it happens to be. Would I convert the RTY level to a confirmation since we can't? Yes, Ingrid, yes. Thank you for that. Great point. From this morning's trade room, this would most assuredly switch to a confirmation entry. Great eyeballs on that one. All right, so I'm going to leave the chat box open for a couple of minutes for, wrong thing. I'm going to leave the chat box open for a couple of minutes for questions that y'all might have. Any questions that you have, or maybe an equity or position that you would like to look at. Real quick, one more, because I know there's a delay. So while I'm waiting on you guys to type in some questions in the chat box, remember, like I said earlier, if you are not a member of Traders Army, go sign up for free. Join us for our free preview week. Get a chance to sneak behind the curtain to see what it is that we do. And I think one of the things people like the most about that is you're going to get access to the trade feed. the trade feed updates are one of those things that I think people really, really like the ability to see and to kind of get a chance to go behind the curtain on that one. So any stocks that y'all want to look at, please make sure you type them inside of the chat box. I know this morning we were looking at, one of them that we looked at this morning was FXI, and specifically this morning we looked at an iron condor in FXI. One of our members was looking at an iron condor, keeping it between 43 and 38.50 as a decent play, and I think that's a that's a pretty good one and a decent one to look at. Another one is Caterpillar. Caterpillar, we're getting a little bit of a rally up. Keep an eye on earnings coming up, but I think that there's some sell opportunity in here. CAT, we talked about a long time ago. Actually, we talked about Caterpillar in our for those of you that watch the Stocks on the Rocks video. If you're not familiar with our Stocks on the Rocks series, it is the most fun thing that I do. I quite literally drink bourbon while talking about stock, so it's great. This was one that we looked at way back here. I still like a reversal area somewhere in here, so keep an eye somewhere on that one. VCAS, when looking at basing, do you ever drop a time frame or consider the hourly? I look at basing on whatever time frame that I identify the breakout. So if I identify the breakout on a 15-minute chart, then if I identify breakout on the 15-minute chart, then I'm looking for basing on a 15-minute. If I identify the breakout on the hourly chart, then I do not drop down to a lower time frame. I only consider the hourly. So where I find the trade is where I need the basing to occur. So the demand zone on CAT that I like a bit lower. I mean, you really got to go out to a weekly chart. Your first decent demand zone on a weekly chart is about 108. My thought was that we would make it down to around the 110, 108 territory, and that's where I would go. Stocks on the Rocks, can one ask questions? So, John, Stocks on the Rocks, I've never done a live version of that, but you can certainly ask questions in the bottom, and I will do my best to answer them. I think it's so much fun for me to do those. If you've not seen it, it's a cool show for me to kind of put together. So, all right, let me see what the next question was. I had another question in here somewhere. Pound is approaching the zone around 2474. At what point decide not to take the trade? So let me go back into the pound. So this one. So let's, we are approaching that level. So right now, I'm still okay with that level. Now, the thing we've got to consider is what's my 4-hour trend direction? My 4-hour trend direction is indeed changing trend direction. So the way I would look at this now, I'm still okay if we come into that level and taking the trade. Totally okay with it at the moment. And the reason being is because I don't have a lower swing high yet. A higher swing low. Higher swing low. I have a higher high, but I don't have a higher low yet. And so as we're rocketing straight up, I still think this level is valid, and we may get a little reversal off of this point. We're actually stalling just a bit at the wick over wick level just below it. You see this little stall we're getting, this wick over wick area. That's why I think this is still kind of valid. Now, the other part is look how small that level is, right? 124.73, 124.87. I mean, this is a tiny little level where you've got very minimal risk. So if you're a little bit concerned with it because of this parabolic straight up move, what you could do is when price comes into the level, if you like the limit entry, take one contract. And if it starts to go your way, take another contract and continue to add to that position as it starts to go your direction. So that's the thing I would say about that. For those of you real quick that haven't seen the Stocks on the Rock show, here it is. I'm going to put the link to it in the chat box. We don't have a ton of subscribers to it yet, but I'd love to have you guys, if you're not subscribers yet, to watch. We got a new one coming up probably tomorrow. We're doing it on Ford and Elijah Craig. So tomorrow's Tomorrow's version is Ford and Elijah Craig. So, all right. Well, I'm gonna I through the website. Also in the chat box, for those of you that are not members, I'm going to log this thing off for today. I really, really appreciate all of you that joined us. If you're watching this on recording, please feel free to come for our free preview week. I look forward to having as many of you there as you can. Thank you all for coming today, and enjoy the rest of your afternoon. And I'll see you tomorrow on our daily market commentary. Have a great day, everybody.